Good afternoon, everyone. I warmly welcome you all to today's webinar. We are glad to have with us Mr. Sanjeev Kumar, CEO and founding member BondView. We will be leading today's session. The topic of today's webinar is the future of bond investing, digitization, transparency, and retail participation. This webinar is being organized under the Financial Education Initiative of the National Institute of Securities Market (NISM), which is supporting today's session. The NISM is a public trust established in 2006 by the Securities and Exchange Board of India, the regulator of the securities market in India. The institute carries out the wide range of capacity building activities at various levels aimed at enhancing the quality standard in securities market. Before we begin the session, I would like to share some important points with all participants. Questions will be taken at the end during the question answer segment. All participants will receive their certification of participation in 3 to 4 working days. The recording of the session will be uploaded on the official NISM YouTube channel. Now, without taking much time, I would like to hand over the session to Mr. Sanjeev Kumar, sir. Thank you.
Thank you. I just request my colleague Meenakshi to give introduction, and then I will start the presentation. Good evening to all of you. Yeah, Meenakshi.
Namaste, good evening to everyone. Thank you to NISM for organizing this webinar. And a special thank you to our guest speaker today, Mr. Sanjeev Kumar. We are delighted to welcome Mr. Sanjeev Kumar, who is the founding member and co-CEO of BondView, to today's webinar. With over 28 years of experience in financial services and entrepreneurship, Sanjeev ji has held leadership roles at Tata Mutual Fund, L&T Mutual Fund, and Shrey Group, where he built deep expertise in strategy, distribution, and capital markets. An IIM Calcutta alumnus and respected fintech leader, he now spearheads BondView, a SEBI-regulated bond platform, bringing fixed income and alternate investments closer to investors across India. Known for his value-driven approach, business mentorship, and passion for innovation, Sanjeev ji offers invaluable insight into the future of wealth tech, fixed income, and digital finance. Please join me in warmly welcoming Sanjeev ji. Thank you.
Thank you, Meenakshi, for your kind words, and thank you, team NISM team for giving me this wonderful opportunity to address, the wider set of participants here, where I'm going to discuss about future of bond investing, digitalization, transparency, and retail participation in India. Before I start the presentation, I just want to set the context of, how I will carry forward the presentation. So I will definitely touch upon the practical aspects of bond market in India, the evolution, what is happening at ground, because knowing the pulse is extremely important rather than just getting through the theoretical knowledge or academic knowledge. That is important, but the practical knowledge and ground, what is happening at ground level, ground pulse is very, very important. So which I will share during the course of my presentation. As discussed by NISM team, we will take the questions at the end of the presentation. If any question require more time for answer, we will definitely connect with you on one-on-one. You will just put your queries on chat box, and we will just connect with you on one-on-one. To connect to the wider set of the audience, I'll cover it in English. Some portion I will definitely cover in English, some portion I will cover in Hindi, so that I can connect with the larger set of audience. So without wasting time, I think the flow of the presentation which I am going to cover, and it is very important, as I discussed, that there will be certain theoretical part, there will be the practical part, and the evolution. So I will cover the entire presentation. The flow would be like this. I'll cover the overview of bond market, what are the components of bond market, where the money is currently going, the key data set of bond market, which are the constituents like Government of India as an issuer, or various corporates as an issuer, or a state government as an issuer, what are the key data set, and what are the challenges we are facing or various stakeholders, so to say, or various intermediaries or various investors are facing, for the development of bond market. We will also cover the massive growth we have seen in other asset class like equities and mutual funds. We have seen massive growth in last 20 years. So what has translated this growth, that we'll basically discuss, and then we will draw the parallel that if mutual fund and equities can grow, why can't bond grow? And then we will also cover the current process of buying and selling of bonds, and to basically solve the larger pain points. What are the solution? Is the OBPP. OBPP stands for one online bond platform provider. Is OBPP is the solution going forward, and how to enhance the retail participation? Then I will summarize the presentation and take the Q&A. Just to give a theoretical perspective, and I'm sure most of you are aware about it, that the development of bond market is extremely important for any economy, be it developed economy or any economy. And India is not different for that. And why development of Indian bond market is important for development of economy? Because it gives more funding options for business. It gives companies another way to raise money by issuing bonds. You can, basically issue bonds at lower, the cost, so it reduces the cost of borrowing. And definitely in today's scenario, it allows people to invest their, hard-earned money, in various saving instruments in the form of bonds. So that is the better use of public savings. It helps in the longer term projects like, highways, airports, because that requires, longer tenor of bonds. So the bond market supports big infrastructure projects. And most important is that it attracts, the foreign investment, because that gives the strengthening of the economy. So all of us know that, but I thought, at the cost of a repetition, I just put the context right before I cover the key data set. So let's cover the size of the bond market. I think we have been, for the last 10-20 years, we have been seeing the enormous growth in mutual fund and equity market, and everyone knows that mutual fund size is roughly 65 lakh crore now, and every month roughly 25,000 crore comes as an SIP. But when it comes to debt market, I think we are not aware about what is the current size of the debt market. How are we positioned vis-a-vis global peers? What I mean to say that, how are we, what is the condition, what are the conditions for developed economy, and what are the conditions in emerging markets, that I will cover. What are the debt issued by various entities? And definitely, the last 5 years or few years, how this corporate bond market has evolved. And as in the beginning of the presentation, I covered that, where the money is going, whether the money is going in high rated bonds, or it is trickling down to lower rated also, or whether it is in the form of private placement or public issue. These data points I will cover during the presentation. So if you see the bond market in India, the outstanding bond, government bond and corporate bond market in India, it is close to, the government bonds is close to roughly 175 lakh crore, which is roughly $2 trillion. And the corporate bond is roughly 50 lakh crore, which is $0.59 trillion, which is roughly 81% of the total. The debt GDP ratio, if you see, it is 81.7%. But if you see the other the markets and compare it where we stand, I think that gives a very eye-opening, you can say, picture. Because if you see the developed economy here in Indian case, as I showed you, because that data is of 25, this data is a roughly, rough data of as on 24. So some anomaly or some difference may be there, but I think what is more important is getting the insight. So Japan, if you see, the debt to GDP ratio is 260%, and the debt market size is roughly $12.7 trillion, where I showed you, in Indian case it was $2.5 trillion. United States, it is 120%. The debt to GDP ratio is 120%, and the overall size is $33 trillion. Similarly, the Eurozone is 90 to 100%, roughly rough figure I'm telling, it is debt to GDP ratio is 90 to 100%. The total size is $13 trillion. China is 85 to 90% of the debt to GDP ratio if you calculate, and the debt size is $20 trillion. Whereas if you come to India, which is we are at the bottom end of the pyramid, if you compare vis-a-vis other developed countries, we're still at 2.2 trillion and 57, 60 or 70%. The debt to GDP ratio is 70, 80% is there. What does it mean? It means it clearly shows that there are enormous opportunities, and we are at the cusp of massive growth, which sooner than later will come to Indian fixed income market. If I divide the entire, basically the market into different subcomponents, GSEC is roughly 46% of the Indian bond market. The SDL is 26%, corporate bond is 23%, treasury bill is 3%, and floating rate is 2%. So still, the GSEC is basically controlling the major chunk of, the Indian corporate market, which to my mind, I think, this picture will sooner than later change due to the various, the interest of various stakeholders and the way we are, moving ahead. If you see, how the corporate bond issuances have been in last 4 or 5 years, so the issue size has grown 46% from 9 lakh crore to roughly 13 lakh crore. The number of issues, definitely it has gone from 3,000 to roughly 6,000. But the most important part, I think, there we need to work, and all the participants need to work, is that still the private placement dominates the major issuance in corporate bond market. The public issuances are very, very low, and understandably so, because of the cost and because of the compliance hurdles, which I am sure, as we progress due to digitalization, these costs will come down, the compliance hurdles will come down, and definitely this market will also grow. The one more data set which I want to basically show, and as I mentioned while showing the data, that is still, if you see, the 95% of the bond issuances is towards AAA rated and AA+, and there are reasons behind it, because some of the the regulations are such that by design, the various investors, institutional investors, will have to invest towards AAA rated and AA+ paper. So, but the case in point is that still it is skewed towards high rated bonds, which probably I thought let me just showcase this. And the second important, the data set which clearly emerged is that still, as I mentioned, it is skewed towards private placement, and understandably so, because if you raise resources through private placement, the costs are low. It is ease of issuances are there. Whereas if you go through public issues, there are more disclosure, the cost increases. So most of the NBFCs and other the issuers, they don't prefer the public issue. But I think the way things are moving ahead, I am sure, as I mentioned, that the cost will come down, the compliance hurdles will come down, and more new players will come and start issuing through public issue, which will basically catapult to the development of, or arose the interest of retail participants going forward. Now, one more important thing which I think it is very important to understand, that still the bond trades are through telephonic market. Just remember the case of equities. What was the case of equities 15 years back, I think, or 20 years back, or 25 years back, when DMAT was not there, the physical delivery was there. When DMAT came into picture, still you used to, and even for that matter, digitalization came, you used to call to your dealer, and then dealer used to punch the order. Similar case is there, in case of bond market at this point in time. 98% of the trade which are happening, in bond market, barring GSEC market has been transformed by NDS OM. But if you see the case of corporate bond market, 98% of the bond trades are happening, through OTC mechanism or a telephonic market. You basically scout for trades, you call brokers give you data set, and then, you basically agree for price, and then, settlement happens. So there is no, complete transparency, there is some opaqueness, there is no complete transparency as far as trades are concerned. But that is a fact, and probably I think there is this bottleneck, if we remove, it will really, help to create a market which will grow sooner than later. So when I was just, showing you the various data sets, I think there are key challenges for the bond market. The key challenges are that definitely there are low liquidity, and low liquidity. Why there is low liquidity? Because the participants are not widely spread. There are poor retail access. Why there are poor retail access? Because most of the intermediaries and most of the investors, they are not aware from where they can buy and sell. There are regulatory fragmentation because there are 2-3 regulators which are controlling it. So there are no unified regulations, and probably I think things are moving in the right direction, so that will be taken care of. Concentrated issuer and investor base, because when I was showing the data set, we mentioned that still it is towards AAA rated paper, and it's still, the participation is from institutional investors. So widespread participation needs to be will definitely come sooner than later. If you see, other, the market, there are more innovation in terms of product design, which are probably, I think, this bond market, completely lacks it. Now, we have discussed about the key data set. We have discussed about the key challenges, but I think in the same market, if you see other asset class, they have evolved. So let's see the data set of other, basically asset class. Other asset class, I think 2 asset class which have seen a massive growth is equity and mutual fund. So if you see equity market cap in 2014, which was 70 lakh crore, has grown to roughly 400 plus lakh crore in 2024, seen a growth of roughly 18%. Mutual fund, the AUM which was 8.3 lakh crore in 2014, has grown to roughly 54 lakh crore. As of today, I think it has already crossed 65 lakh crore. It has seen a CAGR of roughly 20%. The retail book, which was meager 1,200 crore per month, has crossed 25,000 crore per month. We have seen a massive growth, and SIP has become, and why I'm showing this data, because if it can happen in mutual fund and equities in the same ecosystem, why it will not happen in debt? Because of this, I'm just showing this data. So SIP book, which was 1,200 crore, has grown to 25,000 crore per month. The bond market outstanding, definitely there is a growth from 15 lakh crore to roughly 48 lakh crore, seen 11%. But I think most of the growth, if you are seeing, it is from the institutional player. Retail investors are not there. Number of demat account, which basically reflects the growth of equity market, which was 2 crore in 2014, and post COVID and when the retail participation grew, it is crossing 16 plus crore, and that has seen a roughly 7-8x growth in last 10-12 years. Debt mutual fund, which was roughly 5 lakh crore, is roughly now 14 lakh crore, and after 21-22 crisis, it is basically now again coming into foray. But the point which I want to make is that in the similar ecosystem, similar environment, if 2 asset class on the back of the regulatory framework and regulatory initiative and transparency can grow, there is a case in point that that fixed income market will surely grow. So I think the critical component which I just want to highlight is the T factor. There are three critical factors which has given the massive growth in mutual fund and direct equities. One is transparency, that is on the back of regulatory reforms. Second is the ease of execution by technology integration, and A is awareness. I will just give you some sort of evolution process. If you see, mutual fund, there used to be entry load, there used to be exit load, there was only regular plan. The in 2018, the categorization has come where two plans came into foray for the interest of investors, the regular plan and direct plan, to basically minimize the cost. There was capping on the total expense ratio on mutual funds, and these regulatory basically reforms has put simplicity, has brought cost transparency, and that has led to the massive growth of mutual fund. Similarly, in case of equities, T+1 settlement came into picture, corporate governance came into picture, which has a larger impact on the faster execution, which has larger impact on the confidence and trust of investors, and which has brought and propelled the growth of equity as an asset class. Similar thing we are seeing in debt. I'm sure we are at a cusp. For example, in 2018, the electronic bidding platform came into picture. 2021, retail RBI came out with the RBI Direct to basically allow retail investors to participate in GSEC auction. And SEBI mandated various reforms for ratings and disclosure. So things are also changing here in case of debt. But the point which I want to make, the regulatory reforms which was enabled by regulators in case of equities and mutual funds has brought the massive growth in this asset class. The second point which I mentioned is basically about the technology factor, because that also gives the ease of execution is there. So here, the eKYC, DigiLocker, I think the API integration, all these kind of technology innovation in case of equities and the mutual fund has really transformed the equity market and mutual fund market. And similar things are happening here in debt market. I will just cover in the next slides. There is a level playing field in terms of taxation, because earlier, debt mutual fund used to get some privilege in terms of taxation. There used to be indexation and so on and so forth. So now, debt mutual fund and direct debt, they are at the common platform, and hence, if they are at the common platform, there will be more and more, apart from participation in debt mutual fund, there will be more and more participation in the direct bonds or direct fixed income market by retail players. So while I was just giving you the data and giving you the pain points, I think the most important part is then what is the solution? In 2022-23, SEBI came out with as I mentioned that the regulatory frameworks and regulatory guidelines are very, very important to create a T factor. T is the transparency, ease of execution, and awareness factor. So 2022 September, October, SEBI came out with the guidelines called OBPP, Online Bond Platform Provider Guidelines, where players will have to take license and they have to take and the debt brokership, basically to simplify the bond trades, and that we call it as the OBPP. So this OBPP is a way forward. That is the question that we need to answer today. To my mind, I think I will just showcase how OBPP, and particularly I can talk about the bond view, because that platform, we are privy to that platform. I can showcase to you that how bond view, through bond view, we are basically transforming the entire fixed income market and bond market and trying to solve the major pain points of Indian fixed market, which is transparency, which is basically you can say the trade, the settlement, trade settlement, and which is basically awareness. So we believe that OBPP is a solution. So what OBPP does, it is basically a digital stack whereby investor comes, do their KYC, see the bonds, aggregate, curate the bonds. Depending upon the needs, they put the order. That order gets transacted through the clearing corporation settlement, and there is on back of it there is basically the regulators are there to take care of the interest of investors. That is basically the OBPP flow. But if you want to visualize this, let's see how does it look, because still we believe that I think the way we are trading in equity market, can it be possible in debt market or not? The answer is yes. So, and yes, in the form of how OBPP are building the digital framework. So OBPP are building the digital framework by three ways. Number one, they are aggregating the entire listed bond market in India. So roughly there are 27,000 27,000 listed bonds in the market, which is basically Government of India securities, state government bonds, uh, corporate bonds, tax-free bonds, perpetual bonds. So OBPP are aggregating the entire bonds on one platform. So that is completely unique, because if you are getting the entire data set at one place, I think the decision-making capability of any class of investor, and particularly for retail investors, will definitely go or definitely improve. So the first thing is the aggregation of the entire bonds and entire news flow. The second is the curation, because if you see, there are various kinds of bonds. There are bonds based on tenority, there are bonds based on ratings, there are bonds in terms of seniority, there are bonds in terms of coupon. So how can you basically, retail investors or any class of investors, on the basis of the need, they can just put the filter and get the right data set. It is just like giving the e-commerce feeling of buying and selling. So investors can go there, go on the platform, put the filter, get the data set, and take the decision. Third is the transaction. So not only they can see, they can definitely transact, because this platform is linked to the NSE on BSE RFQ, whereby the ask and bid prices are there, and based on that you can negotiate and just cover the complete the deal. Having said that, yes, there are, as I mentioned, that there are lower the participation at this point in time. So liquidity is not great, but I'm sure as more and more players will come into the market, this liquidity will improve. And these three critical components to build the digital framework by way of aggregation, curation, and transaction will surely get fulfilled, and it will solve the major pain points of the fixed income market of India. I will just show you some of the some of the screenshot of aggregation, curation, and transaction to give you a perspective of how does it look. Because whenever you do anything, or whenever you execute any trade, it is very, very important to see and visualize the things. So see the case of aggregation. So what these OBPP are doing, and particularly here in the case of BondView, uh, they have aggregated, or any, for that matter, any the platform, they have aggregated the, as I mentioned, entire listed bonds in India, but also aggregation has happened in terms of market news, in terms of market indicators, in terms of momentum tracker, because these are the critical component before which you should, or any investor should know before taking any decision. Even in the case of institutional investors, or non-institutional investors, or some of the ultra HNI, or some of the partners or intermediaries, they want to know what are the market news. So the entire the global and Indian market news are here, which basically help to take informed decision. Second is the key market indicators, because when you are in fixed income market, the most important part is the macroeconomic data and the benchmark. So here, the entire aggregation is there at one place, whereby you can see the movement and then take a decision. And then, whatever, the bonds are listed, as I mentioned, you can just see that, who all are the top gainers and top losers. As in the case of equities, what you do, you just, basically see the top gainers and top losers, and based on which, you basically take the informed decision. So similar in the case of OBPP, here the aggregations are happening in terms of aggregating the entire listed bonds A, aggregating the news B, aggregating the market indicator C, and aggregating the top losers and top gainers, which basically helps to take the informed decision. Second is basically the curation of the bond. So if you see, as I mentioned, that we are giving the e-commerce feeling. So on the left-hand side, if you see, there are various parameters: the investment purpose, yield, the tenor, coupon, payment frequency, and most of a lot of parameters are there, which basically you can put on the basis of the need. And just once to put the filter, you can see that the respective bonds will come, and probably you can choose and you can invest from here itself. So here, this is the curation part. The third is transaction. So from here itself, you can just negotiate the price, and you can put your transaction that will get settled at the settlement, the clearing corporation of BSE or NSE, as the case may be. And you will pay the amount, and the delivery will come in your demat account on T+1 basis. So the aggregation, curation, and third, as I mentioned, is the transaction is happening at one place. The most important part is that you can also track the portfolio, because whatever, the bonds which are in your portfolio, which you have bought through the platform or even from any other platform, and which is in your portfolio, you can upload it here and just see the movement and see the weighted average yield, see the profit and loss, see their various parameters, track it, and which will help you to basically take the decision whether you want to sell any bonds, whether you want to buy any bonds, whether you want to exit from any bonds. It will give you a comprehensive view of the entire portfolio. Most important part is, if you invest in any bonds, I think there are 3 or 4 things which you look for. And I am sure the layman investors may not understand this, but I think once they navigate the platform, they will be able to understand it. The first thing is the cash flow of the bond. So you choose ISIN, and on the basis of ISIN, when are your interest payments, when are your maturities, so there are cash flow. So one can see the cash flow. That is a very unique feature, and which helps any investor to take decision. Number 2 is basically the credit rating rational. Because if you invest in any bond, I think credit rating is the important parameter. So you can see the credit rating, and if any credit rating is upgraded or downgraded, the notification will come on your email or the mobile, as the case may be, and which will help you to take the decision. So rating rational is there. The third is IM is there, because information memorandum is very, very important part before you take any decision, particularly in the case of institutional investors and evolved investors. It is very, very important. So here itself, you choose your ISIN, you choose your bond, you can just see your IM, you can see your cash flow, you can see your rating rational, and which basically help you to take a informed decision to invest in any kind of bond. So the point which I want to make is the aggregation, the curation, and the transaction. If any platform, if you are getting at one place, it is the complete digitalization, which will, to my mind, I think, which will solve the major pain points of fixed income market, which we discussed, in the beginning of the presentation. Most important features when we are meeting various intermediaries, various players, and various stakeholders, one thing is common, that I think the awareness level of bond market is very, very low. Very, very low means, that though people understand the equity market, but when it comes to bond market, the terminology like yield, like calculation of IRR, XIRR, various the bullet payment, the various terminology related to economy, various terminology related to bonds. I think the awareness level is very, very low. So we thought, I think, it is very important to create a learning hub for various class of investors, whether it is any investor which is at intermediate level who basically don't know about bond. I think this basically will help to learn. The second is the foundational level, which is basically for the intermediate level. You can say people have got some sort of understanding, but basically they don't know beyond certain points of the foundational levels are there. And then there are expert level and the evolved class of investors who can basically go and see. And there are both the modules, the video modules and audio modules. So one can learn, which is a very unique feature of, and I think it is available on all the platforms. But as I am repeatedly mentioned that the OBPP is basically giving and providing solution to the major pain points. So awareness level is very, very important and very, very key parameters which will help to transform the market and which will help to basically solve the major pain points. So if I have to just answer the major pain points which are pertaining to the fixed income market or bond market, so to say, as I mentioned that transparency, execution, and awareness, these are the three critical components for any development of any market. We have seen the case of mutual fund industry. We have seen the case of equities. We have seen that these two markets have grown on the back of transparency and liquidity, on the back of ease of execution, on the back of awareness, creating awareness. For example, in the case of mutual fund itself, there is IAP, Investor Awareness Program. There is a differential, you can say the TER, total expense ratio, depending upon geography, to create some sort of awareness among retail investors. So similar cases there here. As regards these three critical components, transparency, execution, and awareness, OBPP is the solution. We believe that OBPP, how they are building the digital stack, probably I think most of the people, the awareness level is low, but the solution that they are providing in the form of aggregation, in the form of curation, in the form of transaction, in the form of creating some sort of knowledge base, which will bring transparency and liquidity, which will bring the ease of execution, and which will create some sort of awareness to solve the major pain points of bond market. So I think to give you summary and conclude it, I'm just 5 minutes I have. After that, we will just open it for question and answer, because more question will come, the clarity will emerge. We believe that what we have discussed the overall size of bond market. We have discussed how we are positioned vis-a-vis global peers. We have discussed where the money is going. Still, the money is, the participants are institutional participants, it is skewed towards high-rated bonds. We have discussed about evolution of various other asset class, like the equities and mutual funds. We try to draw a parallel in terms of how regulatory framework, how in terms of the building the digital stack in the case of equities and mutual fund has transformed the market. Similar thing is happening here. So probably I think we believe that we are at a cusp of massive growth in bond market. That is our belief, and it can only happen through the digital framework, that is OBPP. The second point which we mentioned is that any regulation which comes into picture and which basically takes care of the interest of investors, that brings the transparency. And whenever whenever in any asset class or any products, if transparency comes, trust gets built, and when trust gets built, retail investors definitely start showing interest in that that particular asset class. The third, the conclusion summary which we are drawing is the building of digital framework by OBPP, where we have discussed about the aggregation of 27,000 bonds on one platform, where we have discussed about the curation based on the need, where we have discussed about the transaction on one platform itself. You can do the transaction, and that kind of digital framework will definitely bring transparency, liquidity, ease of execution, awareness, and scale. So the pain point, the OBPP is basically the solution. And if the case may be, the most important is, if it is happening, that then more and more participants will enter in the bond market. The new set of issuers will come. Typically, if you see at this point in time, very limited set of the issuers are coming and tapping the market. In last 2 years, couple of the players they have come and they have start tapping the market, the public market. But we believe that I think more and more participants will enter. The new set of issuers will come. The skewness, which is completely in terms of private placement, will not fully, but to some extent, it will normalize, and the public issue will definitely come to basically see the interest of retail investors, because whenever we have seen the tax-free issuances in terms of public issue came, whenever any public issue by larger the group came, the retail participation has increased, because when any issuer coming with the public issue, the way the free flow of advertisement, the free flow of awareness is there, and that transforms the market. So we believe that the new set of issuers will come, the issuance through public issue will come, and most importantly, I think as our economy is growing, I think there will be demand for below AA paper too, because there are high quality and good quality companies which are basically, I think the perception is that I think if it is below AA, I think most of the investors are not going through, the appetite is poor, but I think sooner than later, the demand for below AAA paper will also emerge, which will correspondingly, help to develop the bond market, So I will just pause here and open the session for Q&A. I think it is 4:45. I thought, I am on time. I think 45 minutes is not enough to discuss the entire components of fixed income market. But to my mind, I think what is more important कि इसको कैसे सिंपल तरीके से कैसे चीज़ों को बताया जाए, जिससे कि जो हमारे पार्टिसिपेंट्स हैं उन तक ये बात पहुंच पाए कि अगर म्यूचुअल फंड और इक्विटी मार्केट इसी इकोसिस्टम में 20 साल में इसी बैकग्राउंड के साथ अगर ग्रो किए, तो why the fixed income market or direct participation in bond market, why it will not happen, So I think I will just pause here, open it for question and answer. If there will be any question which requires more time, we will take it on chat. Our colleague will just note it down. You can just put your number. We will connect with you one-on-one and try to solve it to best of our knowledge. So over to you, Meenakshi, or the NISM team. Thank you.
Thank you, Sanjeev ji. That was a very insightful presentation. There are a few questions in the Q&A box, so I will just ask them in order and request you to respond to them in that space. So the first question is from Vansh Jain, who's asking, Sir, will bonds compete with stock markets in the future?
You see, I think both the asset class are completely different. The bond is basically meant for different class of investors and can be utilized for doing the right set of allocation. So whether the bond can compete with with the equities or not, but one thing is for sure that if you see the developed market, their fixed income market is bigger than equity market, and we are very sure that in India too, at retail level, I'm talking about, forget about institutional level, but at retail level, and the underlying, the current, which we have just highlighted in terms of regulatory framework, it is just, and in terms of, coming up, building the digital stack by various OBPP, it is a matter of time that at retail level, it will not compete, but it will supplement the equities and it will be a bigger market than equity for sure.
Thank you, sir. The next question is from Anirban Chandradas. How is digitization changing the traditional bond issuance and trading process?
So it's very simple that I will just again answer the question in a very, very simple way. Just go back, 10 years back, how you were buying the equities. You were buying the equities, you were calling your broker, the dealer. They used to punch the order, and the entire cycle used to be, I think, a day cycle. It was not 5-minute cycle, it was a day cycle. Today the cycle has come down to even a second. Similar case, and it as I mentioned, that it is on the back of digitalization, it is on the back of awareness, it is on the back of a regulatory framework, and it is on the back of the building the complete set of digital framework. So similar, and if it has happened in equity, what has happened? Equity market grew, tenfold, 20-fold, So similar thing will happen here in bond market also. Any scale in anything, if you want, if you are supplementing it with technology, scale will, and ease of execution, scale will surely come, because the entire cycle get reduced from 1 day to 1 minute. And if cycle get reduced, it will bring scale for sure. I hope I have answered your question, Anirban.
Thank you. So the next question is from Piyush Rai. Is there any data on bank FD growth 2014 to 2025?
Yes, the data is there. It is not completely handy with me currently. I can share you the data. You can go to the RBI website and you can just see the banking deposit growth, from for the last 20 years. The data is readily available, on RBI site. But you can just give your number here on chat box. If you want, my colleague can download it and give it to you.
The next question is from Koshiji. Will OBPP platform be open for NRIs? If yes, then will the AML KYC of the NRIs happen online?
So in the case of NRI, if you see, there is a ceiling, and NRI, you can divide the NRI into two parts. One is the NRO, investment from NRO, and second is an investment from NRI, an NRE account. As regards NRO is concerned, because that is the money earned in India, so there should not be any problem. As regards NRE, I think there are ceiling. The exact details, we will share it with you. We just share your number, we will share it with you, the exact details. But as in the case of equities also, if you see, both NRI can invest via NRE account, via NRO account, and the KYC is possible. So in case of debt also, there should not be any problem. But the exact details we will come back to you. You just share your number. We will just share the technicalities.
Thank you, sir. Next question is again by Anirban Chandradas. What steps are being taken to improve price discovery and transparency in bond trading, especially in emerging markets?
No, when we were covering the presentation, we mentioned that still in India, 98% of the trade that are happening through OTC market or telephonic market. What you do, you basically scout for trades, go to broker, ask for bid, they bid, and you get the differential bid, for same kind of, the papers. So that is some sort of opaqueness is there. When the digital framework which OBPP has built, more and it will bring more and more participants on the platform. If more and more participants will come, I think the ask and bid range will narrow down significantly. I'll just draw the parallel again. In the case of, let's put mid cap and small cap equities, just go back 10 years back, the spread was very high. But as more and more players, started jumping into the market, the spread squeezed, the ask and bid price that squeezed, and the price discovery happened, very, very finely. Similar thing, will happen here because OBPP will create a platform, and if they create the platform, it will help to bring more and more investors and more players on the platform, which will squeeze the ask and bid price, and the price discovery will happen, to the finest point, so to say. Will it happen today or it will happen tomorrow? I think the answer is no, because it is a process, it is an evolution. In the case of, the equities also, it took, 5, 7, 10 years. In terms of debt also, it will take not 10 years, that I'm sure the acceleration adoption will happen, it will surely come. My sense is that next, the 5 years will be very, very interesting for fixed income market, and right price discovery will happen in even the corporate bond market. It is happening in GSEC, but it will surely happen in corporate bond market. Yeah.
Thank you, sir. The next question is from Madhurima Das. Investment rate of interest due to economics fluctuations like inflation are negatively related to bond prices. Is there any way to reduce the impact of such economic fluctuations on the bond's immediate value or intrinsic value?
No, you can't, because there is a complete correlation between economic development, the various macroeconomic factors, the bond prices, the yield, all these are correlated. You can only hedge it by, let's put, interest rate swaps. There are some derivative, the products by which, you can hedge it, but you can't completely negate it, because these macroeconomic parameters and prices are correlated. And so there is it is the responsibility of the fund managers and the evolved, investors to take care of that. You cannot negate it completely. You can definitely hedge it by various, derivative instruments.
The next question is from Sudhir Kumar. RBI Retail Direct, minimum investment is 10,000 rupees, when minimum amount of SIP is as low as rupees 100. Why not RBI or regulatory authority bring down the minimum investment as low as 1,000 in respect of entire bond market, including private placement? I believe you may agree with me so that the masses can invest into the bond market. Please name the regulatory authority whom we can approach to bring down the face value of bonds.
You see, bringing down 10,000 to 1,000 or reducing the amount is not the solution. Definitely, the solution lies in creating awareness. However, if you see in the case of private placement, earlier the minimum amount used to be 10 lakh rupees, which got reduced to 1 lakh of rupees, just few years back. So in case of private placement, forget about public issue. Public issue is still, it is 10,000 rupees, or it depends upon the issuer, they can reduce and give it to 5,000 rupees, as the case may be. So regulators, in case of private placement, they have reduced the price. In terms of RBI Direct, I think, it is a prerogative of Reserve Bank of India to decide the price. One can definitely advocate However, to my mind, I think 10,000 in the evolving situation when there is a the aspirations level have gone up, the per capita income has gone up. So in that case, to my mind, I think 100 is equivalent to 10,000. So that is my answer. However, if someone wants to address it and approach, the RBI is as an issuer, you can approach and you can write.
Thank you. So the next two questions are related, so I will read both together before I request you to answer. The first is from Harita N. Sir, bonds too have fixed ROI like bank deposit, then why is it stressed? The next question is from Ayush. Many bonds are providing 6% return per year. Is it not less as compared to FD? In FD, you can get around 7 to 8.1% per year. Then why should one choose to invest in bond market instead of FD?
No, your second question, I'll take first question first, and then second question, I think it is not right. I think most of the bonds, even GSEC bond, where 10-year benchmark is close to 6.3, 6.35. Most of the bonds are, the high quality bonds are above, 7.5%. It is not 6%. It is definitely giving at least 25 basis point, 50 basis point, if not more than bank deposits. So I think the second question is not right. I think you can log into our platform and see the various yield curve of various instruments, including AAA rated Government of India securities, and see, and compare it with the bank deposits too. There is a provision you can compare it to the bank deposits too. So that will give you answer. The first question is why people are not participating, why it is stressed. Stressed is not the right word. I think the best word will be volatility, so to say, because fixed deposits are not listed and bonds are listed. And since bonds are listed, depending upon the macroeconomic factor and the interest rate movement, bond prices moves up and down. Whereas, in case of fixed deposits, you invest and you forget and you get your money at the end of the maturity. In case of bond, definitely if you invest 10,000 rupees, you will get your 10,000 rupees if it is bullet payment just at the end of the maturity. But during that period, depending upon the economic situation, the prices fluctuates because of the listed nature. So it has got positives, it has got negatives. Positives are there, since it's listed, you can withdraw anytime you want. It provides liquidity. The negative side is that, okay, you are seeing your price on daily basis, and that should not be the case. So I think that is the answer. Because of listed, you see the stress. If the stress, you are using the word in terms of volatility, but that is the positive for bond market.
So the time is 4:58. I wanted to check with you and the NISM team because we still have 27 open questions and a lot more coming in the chat. How do we proceed?
So NISM team can just guide us and just tell us, how to do that. I am open for that. I can take as many as questions I can.
So you can take one or two more questions, then we are winding up the session.
And you can take, they can just, I request all the participants to write it on the chat box, their questions. If there are ways to just record it, so probably we and our team will answer it to them, if they mention their name and number, or we can answer to NISM team, and NISM team can percolate to them. Yeah, Meenakshi.
The next question is from Pranchi. Can AI take over the place of mutual fund advisors or financial advisors?
You see, AI to some extent, it cannot take place of, because I'll just give you this. This is very important question. It is not pertaining to bond market, but it is pertaining to intermediation. If you see Indian intermediation, how it has evolved on the back of LIC, Life Insurance Corporation. 100 years back, or 50, 60 years back, LIC, that they have evolved intermediation. So in India, you can't remove intermediation, whether it is RIA, whether it is MFD, whether it is anyone. Investors, they need second opinion and they need hand holding. So AI can supplement the role of or the views of MFDs and RIA, but they cannot replace the intermediation process in the Indian ecosystem. That will be, I think, RIA and MFD will have to use that will supplement them to take better decision. It will help to take better decision, to advise to customers, but you can't eradicate completely.
Another question from Dr. Rajiv LB Roy. What should we look while investing in bonds? Is it yield or the coupon rate?
It all depends upon your need and your risk taking ability. If you are a very low risk taker, then definitely you go for government of India bonds or AAA rated bond. But there, you have to compromise with the yield, because there the yield would be in a range of 6.25% to 7.25, 7.5%. But if you want to take a judicious risk, the way people take in case of equities, so if you want to take judicious risk, definitely the parameter of risk will be different. What is in the case of equities, but risks are risk. If you take judicious risk, then probably you have to move down lower on the curve and you have to invest in lower rated paper. However, one need to check the credential of issuers, the rating rationale, how the business are flowing, and you can take the help of advisors before taking that kind of call. But that will give you a better alpha than the GSEC and AAA rated bonds, and understandably so, because the more risk you take, more return you get. To answer the question, I think it all depends upon your risk taking ability, your time horizon, and your asset allocation, basis which you can take a call.
So as a concluding question, I think this question has been asked multiple times by the same person. Arakshit Bajaj, can bonds return beat inflation rate?
To some extent, yes, they can. If you go lower end of the curve, there are bonds available, in a range of 9.5% to 10.5%. However, that will be risky. So if inflation is 5-6%, and if the bond is giving you 9.5%, 10% return, and if we are in the interest rate cycle where interest rates are going down, you can get appreciation also. So if you are getting a return of, let's put 10%, but you have to go down the curve, the yield curve, the rating curve, to get that kind of return. So in that case, they can definitely beat inflation. But in the case of completely, like, so to say, government of India securities, or in terms of AAA rated bonds, there also it is possible, but by on the lower margin, and not always.
So with that, I think we will have to conclude the question answer session. I'll request the NISM team to take over. Any other open questions, please do write to us, and Sanjeev ji will be happy to revert on the same. Thank you, Sanjeev ji.
Thank you so much, Mr. Sanjeev Kumar sir and Team Bonview, for such a wonderful and informative session here. We truly appreciate your time and the valuable insight you have shared with us today. Also, big thank you for all participants for attending this webinar. We hope you found the session is useful. Thank you all, and have a great day.